Imagine a city-state the size of New York, yet bold enough to envision a $1 trillion finance ecosystem by 2030, a finance ecosystem so resilient, so forward-thinking, that it can anchor global capital flows amid geopolitical turbulence. Today, I'm taking you inside that strategy, Singapore's blueprint to become a global finance powerhouse. The foundation of any thriving capital market lies in its ability to attract, retain, and recycle capital effectively. Singapore understands this deeply. To build a financial center capable of weathering future disruptions and competing with global giants, the country has initiated a strategy that doesn't rely on short-term speculation but on long-term structural transformation. One critical component of this strategy is the injection of liquidity into small and mid-cap equities through a deliberate and systematic program. The rationale is simple but profound. Capital markets only thrive when there is vibrancy across the spectrum, not just in mega-cap stocks, but in the smaller enterprises that represent innovation, growth, and the next wave of global competitiveness. By deploying $5 billion under this program, Singapore is signaling to both local and foreign investors that it is willing to do what's necessary to support and scale its financial architecture. But it's not just about the money. It's about building confidence, signaling stability, and demonstrating an institutional willingness to support the ecosystem from the bottom up. Liquidity in mid-cap stocks means more IPO, more investor engagement, more analyst coverage, and ultimately more legitimacy in the eyes of global capital allocators. When smaller companies thrive, they attract foreign capital that is looking for risk-adjusted growth beyond just the obvious bets. What often gets overlooked in conversations about capital formation is how strategic liquidity provision can de-risk the entry point for new investors. When liquidity is shallow, spreads widen, volatility spikes, and investors hesitate. That creates a vicious cycle where companies fail to list at valuations that don't reflect their potential. By contrast, when the system is engineered to ensure baseline liquidity, it creates a flywheel effect. Companies list, investors participate, trading volume builds, and valuation becomes more rational. Singapore is intentionally engineering that flywheel through this initiative. Furthermore, this isn't just a pump of capital. It's a structural reconfiguration of incentives. Market makers are being encouraged to tighten spreads. Listed companies are being incentivized to improve governance and transparency. Index providers are being nudged to rethink inclusion criteria that often skew towards size rather than quality or innovation. There's a deeper alignment here between policy, capital, and market behavior. It's an ecosystem approach rather than a piecemeal solution. The knock-on effects will be felt far beyond equities. Deeper equity markets lead to stronger corporate balance sheets. Stronger balance sheets lead to better credit ratings, and that reduces borrowing costs across the board. Over time, this raises the bar for the entire corporate sector, encouraging productivity, innovation, and long-term planning. Singapore isn't just trying to make its market bigger, it's trying to make it better, more efficient, and more trusted. This transformation also has geopolitical implications. In a world where capital is increasingly cautious and politically sensitive, neutral financial centers that offer liquidity, legal clarity, and policy consistency will become more important. Investors are no longer just asking where the returns are. They're asking where the rules are fair, where they can get in and out without friction, and where institutional credibility exists. By building depth in its equity markets, Singapore is positioning itself as that kind of center, a reliable node in a fragmented world of capital flows. So when we talk about a transformation engine, we are really talking about a vision for how capital markets should function in the 21st century, not as speculative arenas, but as essential infrastructure for long-term wealth creation and economic resilience. That's the real goal, not just bigger numbers, but a more durable foundation. And that requires more than ambition. It requires design, discipline, and the courage to act while others are still debating. In every successful system, institutional structure is what gives strategy permanence. Without the right mechanisms in place, even the most ambitious financial reforms are subject to short-term volatility, leadership changes, or shifting political priorities. What Singapore is doing by evolving its equity market development program into a statutory agency, Equities Singapore International, is not just tactical, it's foundational. This isn't about creating another bureaucratic arm. It's about embedding the functions of capital market development into the institutional core of the economy, ensuring that the strategy outlasts the cycle. Institutionalization is a process of alignment between incentives, accountability, and capability. It signals seriousness. When a country chooses to move a market initiative from program status to statutory permanence, it communicates to global capital providers that the commitment is not conditional or cosmetic. It tells sovereign wealth funds, pensions, private equity firms, and global allocators that the rulebook is stable, that the backing is official, and that the system is built to last. That's how credibility is built in global finance, through structures, not slogans. The proposed agency would not merely act as a facilitator, but as an anchor. Anchors create gravity in capital systems. Equities Singapore International will have the ability to issue financial instruments, co-develop ETF that reflect strategic sectors, and form joint ventures with global players who want long-term exposure to Asia but need a credible platform to do it. This is especially important in a world where market depth and access are not enough. Trust, neutrality, and institutional clarity are increasingly scarce, and therefore increasingly valuable. What's equally significant is that this agency would be able to act across the entire value chain of capital markets, from pre-IPO support to post-listing investor relations, from market maker engagement to governance training for boards. The agency becomes a systemic integrator. It doesn't just plug one hole in the ecosystem, it builds coherence. That's how liquidity becomes persistent, not episodic, when each part of the system supports the other. From issuers to allocators to platforms, the result is compounding trust. And in financial markets, trust compounds faster than capital. The move also solves a structural issue that often plagues mid-sized markets: fragmentation. Too often, responsibilities are scattered across multiple agencies with overlapping jurisdictions and misaligned mandates. What this consolidation does is create a single point of ownership for equity market health. With clear authority and dedicated resources, the agency can take a long view rather than reacting to quarterly metrics or headlines. That's what allows it to run pilot programs, seed new market products, and build partnerships with other capital hubs from a position of clarity and autonomy. Another overlooked advantage of institutionalizing this function is signaling power. When foreign investors evaluate a market, they aren't just looking at growth numbers. They're asking, who's in charge? What's the accountability framework? Can I trust that the incentives won't change halfway through my investment cycle? A statutory agency answers these questions. It shows that the country has thought beyond the headline and into the architecture. And once an agency like this establishes a track record, it can unlock forms of capital, such as long-term sovereign co-investment or patient private capital, that wouldn't otherwise consider a relatively small market. Ultimately, institutionalization is about sustainability. Markets will always move, sentiment will always swing, but when you have an institutional vehicle that's designed to adapt, that can navigate uncertainty while preserving its mission, you create a strategic asset, not just for the country, but for every participant in its financial system, and in a world increasingly defined by fragmentation and short-term thinking, systems that can deliver continuity and resilience will become rare, and therefore valuable. Singapore understands this. That's why it's not just building capital markets, it's embedding them. When you want to build a durable and competitive financial center, you can't rely solely on capital availability or geographic advantage. You have to build the pipes, deep, flexible infrastructure that supports innovation, attracts talent, and enables scale. Singapore understands this. The emphasis isn't just on building more traditional financial services. It's about creating a dynamic, interoperable financial ecosystem that supports everything from high-frequency trading to microloans in Southeast Asia. That kind of expansion doesn't happen by accident. It requires deliberate planning, institutional alignment, and the willingness to bet on the future when it's still uncertain. Singapore's model has been to treat financial infrastructure the same way it treats roads, ports, or telecom networks, core national assets. That mindset has allowed the country to make strategic investments into the digital rails that power modern finance. The result is an ecosystem that's not just reactive to global fintech trends, but increasingly setting the pace. Platforms like Apix, the API exchange, offer real-world testing environments for fintech products, enabling financial institutions, regulators, and developers to interact in a sandbox that mimics live conditions. This de-risks innovation while accelerating time to mark. It's something most financial centers haven't been able to do without compromising stability. At the core of this infrastructure expansion is a simple but powerful idea. Interoperability creates resilience. When systems can talk to each other, when data can move securely between banks, fintechs, regulators, and consumers, you get network effects. Those effects generate scale, and scale generates stickiness. This is how Singapore has managed to position itself as a key node in the global fintech map, despite being small in size. It has become an open architecture platform, flexible enough to integrate with India's UPI or China's Belt and Road financial nodes, while trusted enough for the West to deploy capital into Southeast Asia through its regulatory framework. The presence of the Asian Institute of Digital Finance within the ecosystem is another strategic move. It ensures that the pipeline of talent, engineers, economists, data scientists, and risk professionals is deeply aligned with the country's digital finance objectives. That pipeline reduces dependency on external expertise, internalizes innovation, and creates an adaptive advantage. It's not enough to have technology. You have to have the people who can build, govern, and refine it as markets evolve. Embedding that capability inside your national strategy is how you future-proof your financial system. Payments, too, are a cornerstone. By investing in fast and interoperable domestic payment rails like PayNow and Fast and linking them cross-border with other ASEAN and South Asian systems, Singapore is not only reducing friction, but also quietly becoming the preferred financial gateway for billions of people. In a world moving toward real-time money movement, where latency and compliance costs can destroy business models, this infrastructure advantage is not just technical, it's strategic. Regulatory clarity has been another differentiator. Through iterative frameworks, sandbox licensing, and close collaboration with the monetary authority, Singapore has made it clear that innovation is welcome, but within guardrails. That builds trust with entrepreneurs while assuring investors that the risk being taken is calculated, not chaotic. This balance is hard to strike. Most jurisdictions either overregulate and stifle innovation, or underregulate and suffer the consequences. Singapore's success lies in being proactive, understanding where the next wave of innovation is likely to emerge and preparing the ground in advance. All of this leads to an important realization. Finance is no longer just about capital. It's about code, connectivity, and confidence. Infrastructure is what allows innovation to scale and regulation to remain credible in fast-changing conditions. And when you build that infrastructure with foresight and discipline, you're not just preparing for the next quarter. You're building the foundation for long-term dominance in global finance. Singapore is doing exactly that. In today's world, where the pressure to decarbonize is not only political, but deeply economic, any financial system that fails to incorporate sustainability into its architecture risks becoming obsolete. The shift is no longer about idealism. It's about survival, competitiveness, and long-term capital efficiency. Singapore understands that the next phase of capital markets will be shaped not just by innovation or liquidity, but by the ability to mobilize and direct capital towards sustainable and transitional assets. And it's doing this not just through broad statements, but through mechanisms that tie policy, capital, and technology together into a coherent green finance engine. The approach has been grounded in building enabling infrastructure first. Through the Finance for Net Zero (FinZ) initiative, Singapore is not simply funding green projects. It is creating frameworks, taxonomies, and partnerships that allow markets to price carbon risk, evaluate sustainability metrics, and align funding with credible transition strategies. In a fragmented global market where ESG definitions vary and greenwashing undermines investor confidence, this kind of disciplined structure becomes a competitive advantage. When you offer a rules-based environment with clear disclosures, capital flows more easily. Investors don't want to guess. They want clarity, comparability, and traceability. FinZ provides that. This strategy also recognizes that the transition isn't binary. It's not a clean break from carbon-heavy industries. It's a continuum. That's why the emphasis isn't just on green finance, but also on transition finance. There are trillions of dollars of capital sitting on the sidelines, waiting for bankable, credible, and scalable transition projects. Singapore's frameworks enable that capital to find the right counterparties, companies that are high emitters today but have defined, auditable plans to reduce their footprints. The system is built to reward movement, not just outcomes. That's a more realistic and effective way to drive change in emerging markets and heavy industries. To support this, Singapore has also scaled up its issuance and facilitation of green bonds and sustainability-linked loans. But the deeper value lies in how these instruments are being integrated into a regional context. Through bilateral and multilateral corridors, such as those recently expanded with China. Singapore is positioning itself as the intermediary for green capital across Asia. These corridors are not just symbolic agreements. They are technical and legal frameworks that allow for harmonized disclosure standards, pooled risks, sharing mechanisms, and cross-border settlement infrastructure. That creates liquidity in markets that were previously isolated and fragmented. And liquidity, once present, compounds interest, both metaphorically and financially. What also sets Singapore apart is its ability to anchor this capital with its sovereign funds. GIC and Temasek are not passive allocators, they're strategic partners. Their involvement in green and transition investments sends a signal to the private sector. This is not a speculative phase, this is a structural trend. When sovereign funds back sustainability, linked assets, they validate them, and in doing so, they lower the cost of capital for projects that would otherwise be considered risky or marginal. That's how you bend the curve, by changing the economics of transition through institutional capital deployment. The real insight here is that sustainability isn't a separate pillar. It's becoming the core logic of capital markets. Investors, allocators, and regulators are increasingly looking for systems that internalize environmental risks, that can monetize decarbonization outcomes, and that can adapt to shifting stakeholder expectations. By building a finance system that doesn't treat green capital as a niche, but as the next standard, Singapore is once again getting ahead of the curve. It's not just following the trend, it's building the infrastructure, credibility, and policy coherence to lead it. In a future where every financial decision will be judged not only by return, but by resilience and responsibility, the systems that know how to direct capital accordingly will own the next era of finance. That's what's being built here, quietly, strategically, and with long-term alignment. The real strength of any financial center lies not just in its regulatory clarity or market access, but in the kind of capital it controls, its quality, its patience, and its strategic direction. Singapore has positioned itself uniquely in this regard. With sovereign entities like GIC and Temasek at the helm, it possesses not only scale but stability. These are not just investment arms, they are tools of national economic strategy. And increasingly, they are being leveraged not just to chase yield but to anchor systems, to risk markets, and co-create long-term value with global players. This approach transforms capital from a commodity into an instrument of influence. GIC, with reserves estimated around $466 billion, operates under a mandate that prizes resilience over volatility. It's not chasing quarterly alpha, it's building diversified exposure across asset classes, regions, and cycles. This allows Singapore to be a reliable co-investor in global ventures, particularly during moments of dislocation when private markets hesitate. That reliability translates into influence. When GIC shows up on a cap table or joins a fund, it's often seen as a vote of institutional confidence. That confidence attracts other allocators, creates valuation stability, and encourages broader participation in long-dated projects. Temasek operates with a slightly different mandate, focusing on active ownership and sectoral themes that align with strategic national interest, technology, sustainable infrastructure, healthcare, and financial platforms. Unlike traditional sovereign funds that passively invest, Temasek actively builds ecosystems. Through its holdings and partnerships, it has created flywheels of innovation and capital deployment that extend well beyond Singapore's borders. And now, with the creation of a dedicated private credit entity managing upwards of $5 billion, It's moving deeper into the space where traditional lending has retrenched, filling gaps and setting terms. This matters especially in a world where the appetite for long-term infrastructure and climate-related investment far exceeds the supply of low-cost, flexible capital. Sovereign wealth plays a unique role in that equation. It can afford to be first in, to wait through regulatory bill, doubts and construction timelines, and to absorb risk that most commercial players won't touch without a premium. That's what makes it anchor capital. It sets the floor under which projects don't fall. In practical terms, that means green bond issuances get done. That means early-stage platforms receive funding. That means long-term infrastructure, from ports to data centers, actually gets built. But it's not just about domestic deployment. Singapore's sovereign funds are being used strategically to weave the country into global economic flows. By investing with pension funds, PE firms, and development banks across continents, they gain access, intelligence, and influence. These partnerships are not passive. They shape standards, governance models, and value creation strategies. And as those portfolios mature, they create feedback loops that benefit the domestic market, whether through capital repatriation, knowledge transfer, or strategic positioning in supply chains. This is a long game. It's not about flashy exits or quick wins. It's about building permanence in a world where capital is increasingly short-term, fragmented, and reactive. By leveraging sovereign wealth in this way, Singapore isn't just growing its balance sheet. It's shaping capital markets, at home and abroad. It's engineering conditions where its interests are embedded inside global financial structures, not just aligned with them. In times of volatility, the market looks for steady hands. In times of transition, it looks for leadership. Singapore's sovereign capital is doing both, quietly underpinning fragile systems, accelerating transformation where it's needed, and offering a model of how patient, strategic investment can produce not only financial returns but systemic strength. That's not just good economics, it's strategic advantage. So here lies the lesson. Dominance in global finance doesn't come from size alone. It comes from institutional design, from aligning capital with purpose, from building ecosystems that outlast market cycles. Singapore isn't just chasing a number. It's designing a financial future, anchored in neutrality, anchored in resilience, anchored for the age of AI, ESG, and digital economies. That is how a compact island becomes a global $1 trillion financial fortress. Thank you.